Good afternoon, everyone. Welcome to Dhruva Consultants webinar on the minimum top-up tax that UAE has introduced with effect from 1st of January 2025. We are extremely excited to talk to all of you on this important development in this new year. I'm joined by a number of senior professionals, colleagues, and experts from the international field talking to us about this important development. Let me just quickly introduce to you all our speakers on the session today and how we are going to be running about the webinar. Firstly, we have Michael Hansen, who joins us as one of the panelists who will be sharing his experience from an industry perspective. Michael is a tax director at a very large and a reputed listed organization. He carries more than a decade and a half of experience across different jurisdictions doing taxes globally as well as regionally. So thank you, Michael, for joining us. We are joined by Radhakrishna Rawal, who's a senior tax policy expert, and he's quite a celebrity in the international tax world. After spending about 2.5 decades with consulting, he started working with the UN tax committees and international tax bodies in policy development and legislative reforms. So he will bring in all the experience around, what the domestic minimum top-up tax means for UAE tax businesses today. Thereafter, we have Lars and Jochen. Lars and Jochen are partners from WTS Germany. Lars is a senior international tax partner specializing in Pillar Two advice and implementation to a number of large European organizations. And for the last few years, he has been exclusively doing that. So Lars is going to be sharing with us his experience of how EU has seen Pillar Two develop. Jochen will be sharing his interesting perspectives on technology and Pillar Two. We also have Sandeep with us. Sandeep is my colleague partner based in the UAE. Sandeep will be moderating the questions with our panelists as we go into the session. Apart from that, we have our team members who have been extremely helpful and supportive in putting together this entire conversation, which is Ashish, Prakhar, and Nilesh. So with that, let me just quickly outline how we are going to be doing the overall session. I must say that the session is being recorded. We will be taking questions offline. So if you have any questions, please do send it to us and we will respond to you separately after the webinar is over. In terms of the agenda, we will have Radhakrishna Rawal first speak about what is the legislative development within the UAE corporate tax on DMTT, what are the rules, how does it impact businesses, and what are the compliance obligations that businesses need to be aware of. Thereafter, we will go into a moderation where Sandeep will discuss certain topical issues and key questions that businesses are facing with Michael, Lars, and Jochen. Thereafter, we will end with closing remarks from our side. With that, thank you so much for joining us, and I hope you find the session extremely engaging and interesting. I'll hand over the dais now, the virtual dais, as we say, to RK. RK, over to you. RK, you need to just unmute yourself.
Okay, I'll share the presentation now. If you can confirm that the screen is visible.
Yes.
Okay. So good afternoon all, and I have about 8 to 10 slides of presentation, and I'll quickly run through it before we get into the panel discussion mode. So let's say what is the agenda for this 20 minutes presentation. I'll try to answer what, whom, when, how, and where about UAE QDMTT. What is it? Whom does it apply to? When does it apply to? How does it apply? And where one is supposed to do the compliance. So all these questions we'll try to answer. Before that, let me start with this, and this is kind of a broader perspective about the Pillar Two. What we see here is that Pillar Two, which is the globe rules, consist of three parts: QDMTT, IRR, and UTPR. Now, we'll discuss all three rules one by one, and let me start with IRR. This essentially is a rule which ensure, Pillar Two is essentially the rule which ensure that all the large entities, that means the M&E groups having presence in multiple jurisdictions and satisfying the 750 million euro threshold in 2 of the 4 previous years, pay minimum 15% tax in each of the jurisdictions in which they operate. It adopts a common approach where it says that if a particular jurisdiction does not exercise its taxing rights accurately, then the taxing right moves to another jurisdiction, and the other jurisdiction can levy tax. So that's how the IRR works. IRR essentially ensures that if a particular jurisdiction does not levy 15% tax, or the ATR is below 15%, then the jurisdiction of the ultimate parent entity gets a right to levy tax on the entities which are falling below the UPE. So that results in a situation where, in this diagram, let's say subsidiary A or subsidiary C has a ETR below 15%. Then UPE, which is, let's say, in UAE, if UAE adopts IRR, then it can collect the additional tax. Now, if IRR is not adopted, then there's another rule which is called UTPR, which is a backup rule. And in that situation, the taxing right moves from the jurisdiction of ultimate parent entity to another group entity, the jurisdiction of the other group entities. So here, let's say the UP entity does not invoke IRR, then France or UK, which are other jurisdictions, can invoke IRR and collect the top-up taxes. Now, in both the situations, IRR and UTPR, it results in a situation where the income is lying in a particular jurisdiction and the taxes pertaining to that income are collected by another jurisdiction in another country from the different entity. To avoid that kind of a situation, there's also another rule which they've introduced, which is called qualified minimum top-up tax. And the broader perspective or the broader objective is to ensure that the countries themselves change their behavior and ensure that minimum 15% tax is levied. Under this, the domestic law itself is trying to ensure that minimum 15% tax is paid. So this is QDMTT, IRR, and UTPR. Now, what is UAE done? UAE has not adopted IRR and UTPR, but UAE has adopted only QDMTT. So that's how, in the diagram, if we see, it will apply only to the entities which are shown within UAE, the entities which are within the UAE jurisdictions. Okay, let's go to next slide now, and we'll discuss each of these boxes gradually. The scope of UAE QDMTT is essentially the entities which are UAE entities, JVs, constituent entities, and reverse hybrid entities. The excluded entities are the government entities, the investment funds, and investment entities. These are the entities, which is thought that at a policy level, they should not be subject to 50% tax. And then there are certain exclusions. One is de minimis exclusion. This is for smaller entities where an entity has an average globe revenue of less than 10 million euro and a globe income of less than 1 million. The top-up tax is considered to be zero. And in certain, the turnover and income of certain entities are excluded from this perspective. Similarly, there is an exception created for initial phase of activities of an M&E. And here, the top-up tax is treated as zero when the entity group has a presence in less than 7 jurisdictions and the tangible assets which are situated outside the reference jurisdiction is less than 15 million. Reference jurisdiction is the jurisdiction in which the first globe rules are applicable. There are exclusion for certain categories of income. One is the shipping income is excluded, and then dividend and capital gains are excluded. And then there is also a substance-based carve-out, which essentially ensures that a due compensation is given where there is adequate substance in a jurisdiction, which is in the form of tangible assets and payroll cost. So 7.6% of the carrying value of the tangible assets and 9.6% of the payroll cost is allowed as an additional deduction to arrive at an excess profit. And this goes down to 5% over a period of 8 years. So this is broadly how QDMTT would be calculated. Going to next slide now. How is the QDMTT calculated for the UAE domestic law? As I said earlier, if you look at the diagram on the left-hand side, what remains is only the entities which are UAE entities. So the entities which are situated within UAE, which is the UP, B1 and B2. In this case, the ETR is below 15%. So QDMTT try to ensure that ETR is achieved at 15%. And for this purpose, the total income, the globe income or pillar two income of these entities are aggregated. That's step number one. Step number two is adjusted cover taxes of each of these entities are calculated and then they're aggregated. These aggregated numbers are used to determine the UAE ETR. And this is determined by adjusted cover taxes divided by pillar two income. This is a simple formula. And that gives me the ETR. If the ETR is below 15%, the top-up tax percentage is determined in step number 4. And then in step number 5, the excess profit is determined, which is pillar 2 income reduced by the substance-based income exclusion. And then this top-up tax is applied, top-up tax rate is applied to the excess profit, and additional cover taxes are also added to that. Additional current top-up taxes are essentially the taxes which arise out of the previous year's adjustment. And then this liability, the top-up tax liability, is allocated to each constituent entity within the group in the UAE in the proportion of their globe income. There's an exception that a designated filing entity may take over the entire liability. So this is how the QDMTT process works for UAE. This is applicable only to the entities which are located within the UAE. So essentially CEs, UAE CEs, the JVs, JV subsidiaries, and the reverse hybrid entities which are there in UAE. This process is done separately for the JV group and the reverse hybrid entity groups. Now, what I described in the previous slide looks very simple. However, it's not that simple when it comes to actual application. There are a number of adjustments required to be done to the covered to determine the income of the entity. This calculation is required for each of the entity before aggregation. So there are 28 plus adjustments required to be done. And similarly, there are a number of adjustments required to be done to arrive at the amount of adjusted cover taxes. Obviously, we don't have time to get into each of this, but when it comes to actual application, these issues will come up. Now, there is also something called transitional CBCR. So here the attempt is to ensure that the initial period, the M&E groups are not burdened with too much of compliance. So some simplified approaches are taken, and the UAE transitional CBCR essentially places a lot of reliance on qualified CBCR reports. A lot of the numbers are taken from CBCR report, and then simplified calculations are worked out. So there are 3 tests, and if the M&E satisfies at a UAE level one of these parameters, then the ETR is treated to be 0. One is revenue as per qualified CBCR below 10 million euro, and PBT is below 1 million euro. Now, one may think that this is identical to the previous one, de minimis, what we discussed. The de minimis is required to be calculated as per the globe rules. Here, the revenue is to be taken and PBT is to be taken as per the CBCR. So that is one test. The second test is simplified ETR test, wherein if during the transition period, if the simplified ETR comes to higher than 16% or 70% for the years beginning in 25 and 26, then again the ETR top-up tax is treated as 0. And for this purpose, covered taxes are to be adopted from the qualified financial statement, and adjustments are to be done for taxes which are not covered taxes or which are contingent in nature. And the third test is a routine profit test, wherein if the profit before profit as per CBCR is lesser than substance-based income inclusion, then again ETR is treated as 0. For this purpose, the transition period is defined, and which is a period beginning before 1st of January 2027 and which ends before 1st of July 2028, which effectively means that at a UAE level, one will be in a position to enjoy this benefit for a period of 2 years. The years which are starting in FY 2025, calendar year 2025 and 2026. Here, once a group is out of the safe harbor, it's always treated as out of the safe harbor. So once out, always out approach is one. Now, interestingly, the UAE law also talks about simplified calculation safe harbors. These are incorporated in the law as of now. However, there are some aspects which are to be finalized even at the OECD level. So it is expected that as we move forward, more clarification would be given for this. Now we come to the compliance aspect. All the CEs, all the constituent entities in the UAE are supposed to get registered within the prescribed time, and the domestic designated filing entities are also supposed to be registered. So essentially, a group can nominate an entity as a designated filing entities. Both these categories of entities are supposed to get registered. What are the filing obligations? The filing obligations are that one, that there is a requirement of filing a top-up tax return, and this template would be provided by the authorities, FTA, and they are to be filed by all the CEs to begin with, or they may nominate an entity as a domestic designated filing entity, and this returns to be filed within 15 months from the end of the financial year. And for the first year, transition year, the period is extended to 18 years. There is one more return which is required to be filed, which is Pillar Two information return. And this is as per the OECD template. This can be compared with GIR under the GLOBE rules, and this is required to be filed within 15 months for FY. One has to understand the difference between two returns. The first one is predominantly dealing with the 15% rate within the UAE jurisdictions, and the second return may be useful for determining GLOBE liability elsewhere, in any other jurisdiction if required. So there are two filing requirements one has to consider. Of course, second filing requirements, more things will be prescribed, and the authorities would come up with more clarification as to who is supposed to file this return. Payment of taxes. Who is supposed to pay the taxes? To begin with, top-up taxes to be paid by each of the entities. However, they may, the taxes may be paid by the domestic designated filing entity. There is also a requirement that this is a joint and several liability of all the entities in the relevant group. So entities which are part of the constituent entity, the main group, they have to pay these taxes jointly and severally. That means that the main entity has to pay the taxes, and if it doesn't pay, then the other entities within the group will have to come and pay these taxes. These taxes are to be paid along with the date of filing return, that is the date on which return is due. A question often comes up is that, we have been talking about Pillar Two law for last couple of years, and now UAE has adopted a law in the domestic legislation. Is there a difference between the two? The answer is no. Structurally, both are supposed to be same. Under the common approach of OECD Pillar Two, it's required that each jurisdiction would adopt a comparable law in the domestic legislation. So when one compares the QDMTT of UAE, it largely matches with the OECD Pillar Two laws. Fortunately, they've ensured that even the article numbers of OECD model law and the UAE law are identical, except in certain situations. Having said that, it may not be possible to do a line-by-line comparison, because OECD law as such is still evolving, in the sense that in 21 they came up with a new law, and then they kept on adding more guidance in the form of administrative guidance. And what UAE has done is that certain aspects from the guidance, certain aspects from the commentary are also included in the UAE law. That's how one can compare the two. The UAE law also requires, places reliance on certain provisions of the domestic law. One is the GAR provisions, which are there in the domestic law. So this is for the first time, one will have to see that the GAR provisions are also complied with, and there's no aggressive planning done to avoid Pillar Two taxes or QDMTT. There's an obligation to do record keeping as per domestic law. clarification can be obtained from the authorities. Assessment and penalties will be all levied as per the domestic law. There is a clarification, there's a relaxation as regards penalties, which says that in the initial period, no penalties will be levied, provided the authorities are comfortable taking a view that the MNE has taken reasonable steps to comply with the Pillar 2 law. Now, what is the road ahead? There's a lot of compliance requirement which is emerging from this. There's a lot of new law, new interpretations which are going to emerge from this. So to begin with, an MNE group will have to identify whether it qualifies as an MNE group, whether it satisfies the parameters of 750 million euro, and whether it it is subject to Pillar 2 norms in the form of having a multi-jurisdictional presence. Then one would want to ensure that is there a shortcut, in the sense that is there a way to comply the law in a shorter manner by satisfying the safe harbors. So we just discussed the transitional safe harbor. There's a reference to simplified safe harbors, which will come in due course. And if one satisfies the safe harbors, that gives a lot of relaxation to the entity, so the compliance burden is reduced. Now, having said that, Pillar 2 requires a lot of data, a lot of processes to be followed. So one has to ensure that its internal IT systems are capable of giving all the data which is required for the purpose of calculation of globe income and Pillar 2 taxes. To determine what is the impact of Pillar 2, one would want to ensure that they do an impact assessment analysis. Here, one would want to do a broader working as to the extent to which there would be additional liability for the taxes to be paid by the MNE group within UAE. And then finally, if there are no safe harbors applicable, there's no de minimis exclusion available, then one has to go live and comply with the law. That means one has to go and do a registration, one has to calculate the top-up tax liability, one has to determine who is going to be the filing entity, one has to determine how the taxes are to be paid. Now, this is an additional requirement, and this is to be matched or inserted within the normal corporate tax payment cycle of the entity. Now, these taxes are payable at the end of the year, 15 months after the year is over. But however, there will be obligation to report these taxes in the financial statements for the listed entities on a quarterly results. And at the same time, at the time of finalization of the financial statements, one will have to ensure that these numbers are adequately captured. So the year-end accounting process of the MNE group is likely to be impacted by this Pillar 2 compliance. Now, having said that, this certainly puts a lot of obligation, a lot of new obligations for compliance on the MNE groups which are there in UAE. However, UAE, can be said to have taken a very mature step, in the sense that instead of requiring the group to follow IRR and UTPR, they adopted only QDMTT. By doing this, UAE has also ensured that it doesn't happen that the taxes which are pertaining to the income generated within the state of UAE are taken by some other jurisdiction. So that's a very broad overview of UAE Pillar 2 jurisdictions. And Rakesh, I'll give it back to you with that.
Thank you, RK, for that exciting presentation. A lot of details for businesses to capture. With that, I'll ask Sandeep to sort of come in here and help us with discussions uh, with Michael, Lars, and Jochen, without sort of taking a lot of time from my side. Sandeep, over to you.
Thank you. Thank you, Rakesh. Good afternoon, everybody. And once again, thank you to the panel members for joining in. RK, it was indeed a very useful insights that you have provided. It looks like a simple calculation, but when you showed us the adjustment slide, it appears that it's far more complicated than one could imagine. Now, with this, let us just move to the panel round. Michael, you are a tax director with one of the largest listed entities here, right? And what we would like to understand from you is from a business preparedness perspective, you must have had discussions with the tax leaders across the UAE businesses. What has been that overall sentiment regarding the introduction of this QDMTT or the minimum, domestic minimum top-up tax? The reason I ask this, because I feel companies have just navigated the corporate tax implementation. We would like to know it from you. How prepared are they for this kind of a challenge that is now coming through?
Thanks, Amy. And I think speaking with peers, you see a very mixed kind of response. Some people, they've done impact assessments, they've done some high-level calculations, they understand kind of what that top-up tax would look like. Then I speak to other peers and they've done no work, they haven't looked into it. They were kind of hoping that it would roll on, it would be 2026, 27, like a lot further down the line than when it has been implemented. I think personally, from my perspective, it's not a surprise the UAE committed really early to kind of adopting Pillar Two. So we knew it was going to come. It was just a matter of timing of when it would come. I think ideally we would have had some more time. Like obviously now we know the legislation is effective from the 1st of January post date. So ideally we would have had a like longer lead time, more time to familiarize ourselves with the legislation, get into the rules, understand the real impact for the business versus the high level impact. And I think that's now where the focus is going. I think from our side, we've had a lot of discussions with the auditors as well. The auditors have been asking questions like, what are you doing to prepare for Pillar Two? How do you think it will impact the group? Will it impact the group? So, and we've also had those discussions as well with advisors to go through, like we've done a high level impact assessment a long time ago. So now we'll be stepping into doing a more detailed impact assessment. I think, and just what we're seeing is like the UAE tax landscape, the global tax landscape, they're evolving, and the tax function and the wider business, you have to be agile, you have to be moving with the times. Otherwise, that's when like tax risks, they crop up when you're not prepared. What we've seen recently, we've got existing VAT obligations. Then there were recently new VAT regulations. Then you've got the first corporate tax compliance cycle. Now you've got Pillar Two impact assessment implementation. Now there's the invoicing implementation to go as well. So there's going to be a lot greater strain on the resources in the tax function, the finance function, and the wider business. And so there's going to be a real need to prioritize and manage those resources.
Yeah. Yeah, and I hear you well, Michael. I think if our listeners have understood, you have found a mixed bag where certain clients, certain industries were pretty much well prepared. They saw this coming. Some of them were thinking this will get rolled over. On the legislation, you brought a very important piece. One was expecting the legislation to be out in 2024 itself, now that it came down in 2025. I think to that extent, the relaxation is at least the legislation is broadly in line with the OECD rules. So at least people were then basically getting themselves prepared based on the base OECD model. So I'm sure in a mixed bag, people have to do their bit, industries have to do their bit. And you very interestingly, Michael, you pointed out the landscape change that's happening across the UAE. And there is another question that, of course, I'll be coming back to you. But before that, let us stick around on the Pillar Two aspect only. When you see the roadmap, and RK also mentioned about the compliance piece that's going to be coming over in 15 months or an 18-month cycle. For a large UAE organizations, Michael, how would you want, or how do you see the tax function roadmap to evolve? If at all you need to categorize this under, short to mid to long term and long term aspects of meeting the Pillar Two compliance requirements. I mean, the reason I ask this, and we would like for you to share, your knowledge or your insights, is to how these key elements that we've been hearing about, collation of the data, the role of the technology at what stage it should get integrated, and of course, the finance and the tax function upskilling. How does this all fit into this roadmap that we speak about? If you can just share some lights on this, it will be great for our listeners and the participants.
And I think it's going to be an evolving roadmap. I think as we get into the impact assessment in the implementation, we're going to do a lot of learning along the way. And as we learn, that roadmap will continue to develop, we'll revisit, will change. I think the first, we're going to have to figure out what are those specific requirements? Where are the gaps currently? And that's including there'll be like the interplay corporate tax pillar 2 as well. What have we done for corporate tax? Now, what are the gaps to get us to pillar 2? I think that gap assessment and understanding what the full data needs are, that's kind of like your short term. That's the critical piece. And then you have to evaluate who's going to be responsible for maintaining the data, who's going to be responsible for obtaining the data, like what's the current format of data, what's the future state of that data. And I think hand in hand with that will go what technology solutions, what automation can you bring in? Like, there's a huge amount of data for pillar 2. How can you automate to make your processes more efficient? And we're seeing a lot more kind of technology providers now, like reaching out, wanting to demonstrate their solutions, what they're thinking about. And they also want to understand what are the key business risks, like what do we want to see from these technology solutions as well. And I think you can almost streamline corporate tax pillar 2. Is there something on VAT? Like, how can you automate as much as possible, but kind of do it in one go rather than you just pick up corporate tax, then you separately pick up pillar 2, then you separately pick up e-invoicing, then separately VAT. That's a lot of resource requirements there. And the IT team, the technology teams won't thank you for ad hoc coming back piecemeal with all of these different requirements. Because I think that's really the short term, along with quarterly reporting, like for the listed groups in after March, in April, you've got to be reporting and what's the pillar 2 impact. The auditors are going to want to have discussions and understand your calculations. What impact assessment have you done? How comfortable are you behind those first disclosures at Q1? So, and that's a pretty big task, especially for the first time coming up with these calculations at the same time that you're going through your UAE corporate tax kind of return preparation as well. In terms of kind of like midterm, then you'll be looking to your pillar 2 filings, like what you need to do to get into a state to be compliant for pillar 2. You have filings, you'll have payments, you'll have to make sure there's a process in place to meet those obligations. And then more long term, you're going to be looking at the resources and the structure of the tax function. So probably at the start, you'll think about outsourcing, using advisors, gaining their experience, the technical expertise. But then at what point will you kind of maybe bring stuff in-house or maybe co-source, have a hybrid model? What does the future of the tax function look like when you can really get a handle on all of these requirements? And then as you touched on, Sandeep, throughout this entire journey, there's going to have to be upskilling of the tax team, the finance team, and the wider business team. Like, what is the impact of everything that's being done within the business? There's going to be a cost to that. Like, it could be an extra 15% cost. So you really have to upskill, and kind of like what we need to know as tax professionals will be very different to what the business need to know, to what the finance team need to know. So you have to navigate that throughout the entire kind of roadmap.
I would certainly say that there is a lot to be done. Of course, the way you explained us the short-term cycle, the mid-term cycle, I think the businesses really have to gear up then, depending upon at what stage you are in. So Michael, coming back to the last question, and I think you broadly put this out as part of the UAE changing landscape of tax landscape of UAE. And this is more on the changing role of the tax leaders. It's a very generic one, but certainly we can pick your brains on this. Now, with this upcoming corp tax, pillar 2, e-invoicing, how do you see the role of the tax leaders now? Is it shifting? How are you seeing the engagements that you are having with the board or the C-suite, particularly in terms of managing the risk and ensuring the compliance, and ultimately making sure that tax is well integrated into the broader business strategy? How have you seen that kind of a role change happening for tax leaders?
I think it's changed pretty significantly. Like I moved to the UAE in 2014 when there wasn't VAT, there was no corporate tax, there wasn't discussion of corporate tax. Whereas now there's so many like tax focal points. It's definitely a key topic on management's mind, and especially like I mentioned before, it's a real cash tax impact. Like, there's going to be a payment of 9%, 15% tax at some point. It's going to go out the door. So management, they're really interested in understanding what is the tax profile of the business and what is driving the tax rate. Like they want to understand the ETR, what's behind it, the adjustments, permanent, temporary adjustments, how that differs for Pillar Two versus UAE corporate tax. So there is a real, I think, engagement from management that you see now. And even like discussing with peers, they will see like boards are taking interest. Management wants to know, has tax signed off on this new proposal? Are they aware? Are there any tax risks? Are there any negative tax impacts? What are the costs of doing this from a tax perspective? And management, I think you're definitely seeing a focus and an understanding. Like they were like earlier today, I was in a discussion and the management asked for a training session just to make sure that there was an awareness across the business and people were like taking it into account and factoring it in to budgets. Obviously now you've just got into a 9% budget. Now you have to increase your budgets to 15%. That's a big impact on the business. So you're definitely seeing management taking a keen interest and focusing on tax.
So happily, the tax is getting that attention that it deserves to, right? Moving on, and thank you, Michael. I think these are really good insights that you shared from an industry perspective. Just moving on now to Lars. Lars, we cannot ignore you, right? They have been the the starters of the Pillar Two journey. We have been hearing a lot on the Pillar Two for the past few years. I think you are the front runners. Now, when it comes down to the EU as a whole, what we would like to understand, Lars, is that based on your experience, of course, for our UAE businesses, what are these key lessons that these businesses should take into account? And of course, if you can bring out the pitfalls they should ideally avoid so that there is a smoother transition when we see UAE as a jurisdiction implementing QDMTT.
Right. Yeah. Sandeep, thank you for this question. And of course, also thank you for inviting me to this very interesting webinar. Yes, you're right. I mean, Europe, and I think in particular my home country, Germany, they were kind of front runners when it comes to Pillar Two. On the one hand, this applies to the governmental side because the German government has always been and still is clearly one of the supporters of Pillar Two. But also if you look at the business side, so on the other hand, also the German groups dealt with the Pillar Two compliance much earlier than groups in other countries. I think that's a fair statement. So from WTS Germany side, our more or less right after the OECD model rules were published. And since then, we have been advising on about 150 projects. And yes, we made some lessons. So the projects, all of them really started like centralized projects, meaning they were steered and organized at headquarters level from the perspective of the ultimate parent entity. And obviously, there are good reasons for this because Pillar Two is a tax which has the consolidated group in scope. However, over time, more and more countries, just like the UAE now, introduced domestic top-up taxes, QDMTTs. And that, of course, meant that the center of gravity of these projects shifted partly from UPE level to the local subsidiaries, because it's simply now a local compliance obligations, local rules apply, and in many countries, even local accounting standards have to be used for the computation. And that, of course, means that a lot of the compliant tasks have to be fulfilled locally. On the other hand, even if a QDMTT applies, there are still certain elements of a Pillar 2 compliance, which, at least in my view, should remain at headquarters level. Firstly, this applies, for example, to the scoping, meaning that all entities of the group in the first step have to be identified. In a second step, have to be classified for Pillar 2 purposes. And then in a third step, have to be combined in this jurisdictional blending, which was also mentioned in the introductory presentation. And I believe that only the ultimate parent entity has the best overview of the group structure and potential changes of the structure when it comes to M&A activities. And therefore, I believe only the UPE can do a proper scoping for the purpose of the jurisdictional blending. Secondly, the importance of the transitional CBCR safe harbors was mentioned, and the CBCR filing obligation is at the level of the ultimate parent entity. Therefore, I believe it's most efficient if also the computation of the transitional CBCR safe harbors remains at UPE level, and that also the UPE takes care that the CBCR is actually a qualified one. So yeah, thus in summary, for a QDMTT jurisdiction, it is crucial, in my view, to allocate the compliance task wisely between the UPE and the local group entities, and to have clear processes and a constant communication. This is definitely a key lesson from our experience, and that turned out also to be very important now for the 2024 year-end tax reporting exercise, where we currently assist our clients. So key lesson, and I think you also mentioned pitfalls, right?
Absolutely.
I could name numerous examples, I believe, but let me focus maybe on the field of M&A. Because I think it's simply important whenever you do an M&A transaction to now consider also potential Pillar 2 impacts. And in the interest of time, I would briefly mention two examples. First one, let's assume your group sells certain group entities to an external party during the financial year. Let's assume the sale takes place today. Please keep in mind that for the Pillar 2 compliance, the entities which are sold, they are still part of the 2025 compliance, at least for the period from 1st of January until today, 2025. This is how the Pillar 2 rules work. And therefore, it's important for later Pillar 2 tax return filing that it's agreed and ensured already in the SPA that the selling party gets all the information which it needs for the Pillar 2 return filing in 2027. It will need the data from the sold entities, and that should already be agreed in the SPA. Second example, very quickly, internal group restructurings like mergers. Whenever a goodwill is triggered, and this goodwill can be depreciated for local tax purposes, which is, for example, the case in Germany, then the current taxes are reduced by goodwill depreciation, but you typically do not get a compensating deferred tax expense, because at least under IFRS, goodwill is not depreciated on a regular basis. And this means that the so-called, it's getting very technical, I apologize for this, but this means the DTA recapture rule disallows the recognition of the deferred tax expense. So in simple terms, goodwill depreciation can reduce the effective tax rate, and that should be checked before carrying out mergers.
Perfect. I think, Lars, these are very, very good observations that you made. Of course, one, if I need to put it in summary, in terms of the learnings you pointed out, the segregation of the job and the responsibility between UP and the constituent entities is something one needs to apply when we see UAE as a jurisdiction. And in terms of the pitfalls, we can't agree with you more. I think Rakesh and I were anyway having this chat this morning where we spoke about how the structuring is being done at a UE level, where you have certain reliefs being available under the UECT law may not necessarily be applicable for the pillar two, computation. So I'm sure this is something, this point gets correlated to this. Lars, moving on to the next one, and I think Jochen, this is where you may also come in from the technology side of it. The question I would like to ask, we have been hearing a lot on the technology. Like there has been a growing emphasis on, people coming to us on the technology-driven solutions for Pillar 2 compliance. Now, what we want from you is share your experience from a standpoint that at what stage do you feel that technology becomes critical in this whole Pillar 2 compliance process? Is it something it is must to have from the very beginning itself, or a phased manner approach is more practical from your standpoint? If you can just throw some light on this, please.
Yeah, sure. So just based on my experience, and I think Jochen will certainly add at a later point when he will present the available IT tool solutions, but just based on my experience, I'm clearly a supporter of a phased approach. Why is this? I mean, first of all, I think it's important to understand that IT Pillar 2 support is required for different computation tasks. First of all, I just mentioned it, it's a year-end tax reporting, and we are currently very busy with helping our European clients for their 2024 accounts. And for such year-end tax reporting, it is generally acceptable to perform very simplified calculations, as long as the results of these calculations are, from an accounting materiality perspective, correct. Thus, at year end, you typically have very simplified approach and a simplified approach. And based on the transitional CBCR safe harbors, you can typically focus on a only limited number of countries and a limited numbers of entities and calculations. In this case, I think for year-end tax reporting, you do not necessarily require an elaborated IT tool. I mean, each group is different, of course. Each case needs to be assessed separately, but generally speaking, I think for year-end tax reporting, a rather simple Excel calculation should be sufficient. And we can see this also in Germany. Also, the biggest German groups have, or most of them have done their 2024 Pillar 2 calculations completely based on Excel. Okay. And that was accepted by auditors. Yeah, I believe, but that's probably, I don't know whether I could hand over to Jochen for his presentation, but when it comes to Pillar 2 tax return filing, of course, tax returns have to be precise. In Germany, they have to be 100% precise. There's no materiality, no simplified approach. And then I think we have a different game simply.
Thank you. Thank you, Lars. Jochen, people would like to see the technology tool or the presentation that you want to make. So over to you.
Sure. Let me share my screen. So hello and good evening to all of you. Just 1 second so I can share my screen. I totally agree that an IT solution is not maybe the first point in starting with Pillar 2 obligations. It's not definitely necessary for year-end computation, but definitely, at least in my perspective, necessary to do the compliance, the IR filing and others. What could be done with the support of a technical solution? You can see here the first step, this impact analysis. As already mentioned, you need to make sure you know how you're impacted by your group, your companies. And when you provide the information like CBCR data and others for the transitional safe harbor rules, you bring that in, you use a tool to analyze it and to, let's say, show on a screen a world map and others where you can see how your group is impacted. Is it really impacted? In which country, in which level, and on which amounts might be here in the risk. That could be something supported by a tool, not necessarily by a tool, but that might help to visualize the impact on your group. Then the second is when you are in the year-end calculation, you need to have a data source in your existing accounting systems, in your consolidation system. You need to find the pieces of information that are necessary to do the calculation, the minimum amounts that are necessary to do the calculation. And you can do that either based on an Excel tool that might be developed in-house, but there are so many specifics already mentioned here in this webcast that something from an advisor who has done that many times with many clients, that might help to increase the level of accuracy for the calculation. Some specifics like Lars mentioned, recapturing and so on. That's really when you have a sophisticated Excel-based tool integrated in the solution, calculated and matched over from the country level to the group level, etc. So tools might be in the needs, but you can also do it in-house, but you could also go to an advisor and ask for such a sophisticated Excel tool. Then, of course, if you have a second step, you need to step up from the year-end calculation, which might be not as exact as the filing obligations are. But if you step up from the year-end approach to the compliance approach, here you need to set a new process. You have to get the exact figures, the exact numbers. You have more time for that. But in that step up, in general, most clients now they implement an IT solution. And here is just an example, an SAP-based solution. So if your ERP system has the ability to provide some calculations on Pillar 2, even including a compliance solution, that might be something because your data already is in your ERP and accounting systems. And if it's already there, you can just use it to compute Pillar 2 top-up taxes and also QDMTT, of course. And what also has been mentioned here in the webcast is this outsourcing to an advisor, or at least a co-sourcing, where you say, we have some internal resources, we know our data, we can get the information up and running, we can also ensure quality in that obligations, but we need some external advisors to help us with the level of detail, who do that for many other companies as well. So you can make sure your filing obligations are met at least the percentage of quality which you feel happy with and feel comfortable with when you file the tax return, the IRR, etc. So that is what you can see here. You can use technology from the beginning of the project, so to say end to end, or you can step in at any time. Many companies say we start more Excel-based, more in-house, more hands-on, and then during the project, step up to a tool, to an IT solution that's really sophisticated to really help them do the obligations, especially with regard to the filing obligation. And what you can see here on the next screens, just let me flip through that very quickly. Here is something which I mentioned, this impact analysis. You upload the information and then you get some overviews, how many countries are of relevance, how many might or might not fill or get through the transitional safe harbor checks, etc. You can have an Excel-based Pillar 2 calculation. You can see that here, just a sophisticated Excel solution when you start with your year-end calculation. This is really helpful because here you can see your regulations and which are based, the data you need, which are based on which regulation. And then, of course, SAP or any other ERP system might be the base for a calculation. Again, the advantage is data is within that solution. You don't have to transfer it out, transfer it back, but it's an integrated solution, which might always be helpful in getting a high level of automation, reducing manual data entries, and ensuring the quality that's needed. Or you can outsource it. So you say, I'll get an Excel template from my advisor. We do that together with the advisor. have a validation to make sure the data is of quality, do the calculation outside of your company and get the results back so that you can match with everything in-house and do the filing either with the advisor or in-house. Point is, it definitely depends on the size of your company, of the resources, the internal resources, the existing level of, let's say, technology. If you're just in a starting position and not that sophisticated with tools, I'd say we can start also then at the lower level. But if you already have a very good technology stack in-house, of course, you can build on that also for Pillar Two.
Perfect. Perfect. Thank you. Thank you, Jochen. I think the key message here is that technology, you cannot have one simple solution of applying technology. It has to be a phased approach depending upon what size are we looking at, what stage are we there in terms of the Pillar Two implications. I think it's a phased approach. Point well taken. With that, thank you, Jochen. Thank you, Lars, for your valuable insights. Rakesh, why don't I hand it over to you in terms of the questions to RK, please?
Sure. So I think we have a couple of more interesting and topical questions as well, which could be of interest to UAE businesses, more importantly. So, whenever I hear taxes, whenever I talk about taxes with clients, their first question is, what can we plan? How can we go about, reducing our effective tax rate? So even if 15% has come in, RK, what is it that businesses in the UAE can look up to, mitigate the impact of this 15% tax? For example, we had represented last year when UAE had introduced a questionnaire, or the MOF had introduced a survey or a questionnaire on Pillar Two, and they were supposedly to announce incentives for research and development or for high value employment. Apart from that, I'm sure the DMTT rules themselves refer to certain, relaxations. But what's your view on how businesses can save taxes here?
Well, Rakesh, I would say, last December, we did see the announcement coming from MOF. And of course, the final rules are, yet to come out. The final scheme for incentives is yet to come out. But, but whatever they announced, I think that's a good announcement. They are going to give an incentive for R&D and for high-level senior C-suite employees. And then these two incentives, the way I see it, should ordinarily kind of satisfy the requirements of OECD inclusive framework, in the sense that if they in the terms of globe rules, there are two categories. One is a qualifying refundable tax credit, and one is non-qualifying. The way I read it, what has come out so far is that they would want to structure it in a manner that it qualifies as a refundable tax credit. And when it qualifies, one is it gives an incentive, and at the same time, it has a lesser adverse impact on the globe working, because if the incentives are structured in a manner they do not qualify as a refundable tax credit, they are going to more adversely impact the globe working. At the same time, when you have a higher level of employees coming in, okay, they would generate more economic activities within the jurisdiction, and at the same time, that would have a good impact on the substance-based, carve-out income exclusion as well. So it's going to have kind of a dual benefit in that sense.
Sure. Thank you, RK. I think, sort of our understanding also indicated, and apparently the MOF indicated two different dates for announcements of these incentives. One was supposedly from, 1st January 25, whereas the other one was from 1st January 26. So it is a bit interesting. Although rules are not available, I would still feel that, businesses must be on the lookout for these incentives and try and, maximize their benefits that they can. The other question which we've seen businesses take, and I'm just conscious of the time as well, maybe the last question, RK, Pillar Two, transfer pricing, safe harbor, some of these are all intertwined, right? You referred to in your presentation about, how we have to use the CBCR reporting to, do a simplified compliance. So here the question is, how do these Pillar Two rules interact with transfer pricing regulations? And what are the things that businesses could take benefit of from these safe harbor provisions, especially when they are operating in multiple jurisdictions? So are there any, simplicity initiatives or benefits that groups could take benefit of under the Pillar Two rules?
Yeah. See, the biggest benefit, one can take is kind of, availing the benefit of transition CBCR, safe harbor. Now, for this purpose, one is to ensure that the CBCR is as per the OECD standards, which is qualified CBCR. So they have to ensure that the CBCR meets those requirements, and UAE is probably as early second or third year of the law on CBCR, so that benchmark would typically be met. Another thing, if we look at the interaction between the transfer pricing and the globe rules, the globe rules give a very specific definition of arm's length pricing, so that that really helps in a broader understanding, and which can easily be compared with what is in the OECD transfer pricing guidelines. Then it requires, it has a certain specific provisions, which require compliance with transfer pricing, in the sense that the transactions need to be at arm's length, especially when the transactions are between, they are cross jurisdiction. So one entity within UAE and one outside UAE, they need to be at arm's length. Exception to this is that, when there's a unilateral adjustment, which is going to result in, double taxation and double non-taxation, that time it will not be applied. Even for transactions, for the entities within the jurisdiction within UAE, if the transfer of asset results in losses, then one is expected to comply with transfer pricing provisions as well. So yes, transfer pricing is a very important part of it. Satisfaction of transfer pricing CBCR, gives a lot of advantage, a lot of easy way out from compliance perspective.
Yeah, and I think I'd like to correlate it with the UAE businesses who probably seen the importance of transfer pricing over the last year and a half when corporate tax was introduced. Is if you look at free zones, right? That is a minimum mandatory requirement that free zone entities need to be at arm's length when they transact with their related parties to protect their free zone status. So probably something similar that we are seeing within the Pillar Two rules. In that sense, it shows that UAE is really at the forefront at adopting best practices in international tax legislations within their domestic law, as well as within some of these international frameworks. I think I'll take a pause there, and with that sort of we'll draw a close to today's session. Thank you, Sandeep, for being an excellent interrogator. Thank you, Lars and Jochen, for sharing the EU experience, which is where probably all of this originated, good or bad, but yeah, it is, and it is fun for all of us to learn and sort of travel the journey along with it. Thank you, Michael. I really like the way you sort of mentioned about how ETR is being conversed at the management, and the question as to what's driving our tax profile. I think that was really nice, very important as to how tax is now interplaying its role with finance and business. Obviously, RK, you've been an excellent presenter in terms of simplifying an extremely complicated legislation, which probably very few people globally tend to still understand and are only understanding it better, right, over a period of time. So I think thank you so much, everyone. I thank all the participants for being patient listeners. Till we meet next time, wish you all a good day and an excellent week ahead. Take care.
Thank you. Thank you.
Bye-bye.
Thank you, everybody. Thank you.
Thank you. Bye-bye.
Thank you for your time. Bye-bye.